Hello, this is Leroy Meadows, and in this session, we're going to be examining and learning about cost volume profit analysis. Now, cost volume profit analysis is predicated on the understanding of cost behavior, fixed costs, variable costs, stepwise costs, and so forth, and also how to measure cost behavior, whether you're using the high-low method, scatter diagram, or regression analysis. So if you're unfamiliar with cost behavior, I would strongly suggest you review the last session where we talk about the fixed costs and variable costs, because that is going to be very important going forward, not only in this chapter, but in subsequent chapters and subsequent topics as well. Now we're going to follow the example that we've been using in this chapter with Riddell and the making of footballs. Just as a reminder, Riddell sells footballs for $100 per unit. And so now we're going to break down and learn how to use this different steps in cost, volume, and profit analysis. So let me start by laying a foundation. The very first foundation I need to lay is understanding contribution margin. Now, what is contribution margin? Well, from a financial or an academic standpoint, I can just say the contribution margin per unit is the sales price per unit minus variable cost per unit. But what does that mean? That means that contribution margin is after we can take into account all of our variable costs per unit, that is the amount of money left over to cover our fixed costs. And subsequently, I can calculate contribution margin ratio, which is going to be as a percentage of sales, by taking my contribution margin per unit and dividing it by sales price per unit. Or I can take my total contribution margin divided by my total sales. So I can look at it as on a per unit basis or in aggregate. So let's take a look here for Riddell. Riddell sells a football for $100. The variable cost per unit are $70. So remember, variable costs are those costs that change in direct proportion to output. So if output increases, the variable cost per unit will stay the same, but total variable cost will change. So taking our sales price of $100 per unit minus our variable cost per unit of $70, and this will leave me a positive contribution margin per unit of $30. Now, in order to to determine the ratio, I want to take my $30 here, my contribution margin per unit, and divide that by the sales price per unit. And we see that over here. And so my contribution margin is 30%. So on an individual level, this contribution margin per unit, what does that mean? That means that after I take all my variable costs into consideration, I have $30 left to cover or to go towards covering fixed costs. Now, typically, contribution margin on a per unit basis is not going to cover all of our fixed costs. If all of our fixed costs for rent, depreciation, salaries, and so forth were less than $30, then the sale of one football would cover all that. Now, obviously, $30 is not going to cover that. So this is on a per unit basis. So if I want to know what my total is, I'm going to take my contribution margin per unit and multiply that by the number of units sold to get my total contribution margin. To get my total sales, I'm going to take my selling price per unit and multiply that by the number of units sold. And the same thing with variable costs. So if I want the variable cost per unit times the number of units sold. And that's how I can get my aggregate information or my total information, my overall information for the total number of footballs that I've sold. So, but on a per unit basis, and this per unit basis is going to help us make a lot of decisions. One thing I want to point out is that our contribution margin per unit should always be a positive number. Why? Because the more we sell, the more we can cover our fixed costs. And we'll see this later, where we have fixed costs to account for. But let's say that it cost me just in variable costs $110. Let's just pretend that my variable costs were $110 per unit. If I sell the football for $100 and the variable costs alone were $110, my contribution margin per unit would be what? A minus $10. So I'd be losing $10 on each sale without even taking into account my fixed costs. So we want to make sure that our contribution margin is positive, because any positive amount of money left over after taking our variable costs into consideration will help go to cover our fixed costs. So now, with that understanding, we can make a number of managerial decisions. The first one we can look at is computing the break-even point for a single product company. So let's say our company just makes one product, or then how many units do I need to sell to break even? So let's examine the break-even point. Now the break-even point could be measured either in unit sales, or units rather, or break-even sales is the sales level at which total sales equals total costs, resulting in zero income. So that means my total sales minus my total costs gives me zero. So I've just broken even. I've not made a profit, but I've also not lost money. Now the break-even point can be stated in either units, the number of units I need to sell in order to break even, or it can be represented as dollars of sales. How many dollars of sales do I need to have in order to break even? Now, let's think back to our illustration here about Riddell. They sell footballs for $100 per unit, and they have $70 of variable costs for each football sold. Now, its fixed costs, as we're going to see, are $24,000 per month. So we're going to show three different methods here to find the break-even point. The first method is the formula method. The second method is a contribution margin income statement. And the third method is a cost volume profit chart. So let's take a look at the formula method. The formula method is just plugging numbers into a formula to get our output, how much we need, how many units we need to sell, and how many dollars of sales we need to have. So what we're going to do to determine our break-even point in units, and our break-even point means that total sales minus total costs equals zero. So I'm going to take my fixed costs of $24,000 and divide that by the contribution margin per unit of $30. Now, when I do that, I'm going to calculate 800 units. So 800 units are going to be what I need to sell just to break even and take all my costs into account for selling football. So I need to sell 800 units to cover all my costs, either variable or fixed. Now I can also calculate that in dollars. I can take my fixed costs, divide that by my contribution margin ratio here, which we determined was 30%. So I'm going to take 24,000, divide that by 0.30, and that's going to give me $80,000 in sales. Now, does that look like it's going to be right? Yes, because if I need to sell 800 units and each football sells for $100 each, 800 footballs times the sales price of $100 each is going to give me $80,000 in sales of Riddell's footballs. The next thing we can do is look at the contribution margin income statement method. And for me, this is typically what I prefer as far as not necessarily the break-even point, but for further analysis, because with this contribution margin income statement, especially if we're using Excel, we can change the input some data and do you know, play around with, some sensitive numbers that may be sensitive to, let's say, the economy, like sales. labor costs and so forth, we can actually break each one of these down by the different variable costs, so we can look at data sensitivity here. But for calculating just a break even, this is best. A break even point in units and dollars. For a lot of other things, it would be preferred to use a contribution margin income statement at break even. And for break even points, we can look at here and confirm that it takes 800 units to break even. So I need to sell 800 footballs and at $100 each for $80,000 in sales. So let's look at the contribution margin income statement. The contribution margin income statement is going to be different than our absorption costing or our traditional gross profit income statement. Remember that under the multi-step income statement, or we can do a single step either way, we have sales minus our expenses gives us our income. And if we use a multi-step income statement, is sales minus cost of goods sold gives us our gross profit, minus our operating expenses gives us our operating income. Now here, and that's the traditional format under absorption costing, and I'll explain why we call it absorption costing later. But under traditional costing methods that are approved for GAAP, we would use the other multi-step income statement. But for making managerial decisions, we want to look at the contribution margin income statement. So the contribution margin income statement focuses on cost behavior, whereas our traditional multi-step income statement focuses on cost classification, product costs, and period costs. So we're focused here on cost behavior. So I'm going to take my sales. I'm always going to start off with sales no matter what type of income statement I do. So sales, and for the contribution margin income statement, I'm going to separate and deduct my variable costs. So as you can see for Riddell, to sell 800 footballs at $100 each, it's going to net me $80,000 in sales. Now, when I subtract out my variable costs, I'm going to subtract out 800 units times $70 each to give me a total of $56,000. So that leaves me with a contribution margin of $24,000. 800 units times $30 a piece. Remember that $30 is our contribution margin per unit. And remember that contribution margin means this amount here is what I have left to cover my fixed costs. And in this case, my fixed cost of $24,000 is equal to my contribution margin of $24,000. So $24,000 minus $24,000 gives me 0. And this is my break-even point here, when my sales minus my total cost, variable and fixed, equals 0. So this is the break-even point stated in a contribution margin income statement. So, and we're going to get familiar with this over and with the income statement, but with the concepts of sales minus variable cost minus fixed cost, we're going to see this in a lot of different decision makings going forward, not only in this chapter, but in subsequent chapters as well. So just make sure you're very familiar with this, because this is going to be important here. Now, the third way we can find a break-even point is examining a cost volume profit chart, or a break-even chart. Now, let's identify a couple things here real quick. The red line here are total costs. And remember, our total costs are going to have some variable and some fixed components. Remember, the fixed costs are incurred even if we do not make any sales. So even when my sales or units sold are 0, I'm going to incur, what we say, $24,000 of fixed costs. So that's going to be my starting point. Now, in addition to that $24,000 of fixed costs, for every unit I sell, I'm going to incur $70 of additional costs for every unit I produce and sell. So the more units I produce, the more costs I'm going to incur. I'm going to incorporate the $24,000 flat. I incur that no matter what, but my total costs are going to go up. Why? Because it costs me $70 additional as Riddell to make every additional football that we sell. So my total cost will go up. And now let's look at my revenue line, my sales line. Now with sales, if I don't make anything or I don't sell anything, then I don't have any revenue coming in. So of course, zero sales equals zero revenue. But as I sell more, the more I sell, the more total revenue I get. So this is where I have my green line here. The more I sell, the more revenue comes in. I'm happy. We love selling more things to make more money. Now, let's look at the point where these two lines meet. The point where the total sales line equals the total cost line on the graph, that is my break-even point. So this right here, $80,000 and 800 units sold. That's where my cost break even. So if I'm graphing it this way, or I'm looking at it this way, and I'm graphing it, this is what it would look like. This is where my two lines would intersect right here, and this is what it would look like graphically. Now, let's look at the shaded areas. The pink shaded area here is the difference between sales and total costs. This is where I'm operating at a loss. But if I have positive contribution margin, which I would expect to have, the more I sell, the more the smaller that loss is getting, up to the point now where I break even. So if Riddell breaks even at 800 footballs sold and selling them for $80,000, then what happens if I sell more? Well, for every unit I sell above 800, I'm going to have I'm going to have an operating profit because my sales here are greater than my costs here. On the bottom part of the chart here, my costs are greater than my sales, so I have a loss. Here I break even, and then when my sales right here are greater than my total costs here, then I have a profit. And the larger that and the more sales I make, the larger my profit will be. And we like that profit area. As a business owner, I like seeing profit, so we want that blue shaded area there. Now, we're going to make some measurements later on in this session, but I want to introduce it now. If I could pick any point here on this as far as the number of units sold, let's just say I had 1,400 units sold. So I'm up here. The difference between my units sold and my break-even point is going to give me a cushion. So any point up here, I have a cushion that if things go bad, let's say the economy slows down or we're out of season or what have you, or some assumptions change, maybe our costs go up or whatever, or maybe we have a competitor go in, so we start selling less and less footballs. Whatever the reason is, there could be a number of reasons why our sales decline. At any point here, I have a cushion between here and the break-even point. That's called my margin of safety. And that's a cushion between my actual sales minus my break-even sales. And I'll explain that a little bit later. But this helps us have a cushion so that in case of a downturn of sales, then we have a cushion where we could absorb some of that and not be hurt as bad. Now, if we start selling less at our break-even point, then obviously we need to make some adjustments because we would have less revenue come in than our total costs. Okay. Now let's take a look at changes in estimates because we're making certain assumptions here. we're making assumptions that our fixed costs are $24,000. We're making assumptions that our sales price is $100 per football, and our variable costs are $70 per football. But what if something changes? Now, we have estimates here that most likely we'll be able to sell a football for $100 per unit, and it'll cost us $70. So we'll have a contribution of margin per unit of $30 per football sold. Our total fixed costs are $24,000. Our break-even unit in sales, or break-even in units, is $800 or 800 units. But what if we're really concerned and we have a pessimistic outlook? Because we want to take into account different types of outlook, and you'll learn about that in the finance class. But let's say that pessimistically, we might only be able to get $96 per football. The variable cost of footballs is going to increase by $2. So our sales price is decreased by $4. Our variable cost per unit has increased by $2. So that only leaves us a contribution margin of $24. Now let's say that our total fixed costs increased to $27,000 for whatever reason. Under this scenario, I would need to sell 1,125 footballs in order to break even. And we see this revised break-even point formula here. $27,000 divided by a fixed cost divided by $24 contribution margin per unit leaves me with sales I need to get of $1,125. So we can take into account changes in estimates, whether economic indicators, different things like that, to make some adjustments to see, and under different situations, what would happen. Now, from this, I can learn three different things, three different behaviors with regards to my estimates. If my sales price per unit increases and everything else stays the same, my variable cost per unit stays the same, and my total fixed costs stay the same, then my break-even point would decrease. However, if my sales price per unit decreased and everything else stayed the same, then my break-even point would increase. Now let's look at variable cost per unit. Here's another thing we can learn. Assuming my sales price per unit, I'm selling each football for $100, my fixed costs remain at $24 or $24,000. If my variable cost per unit increases, then my break-even point would increase. Okay, but the flip of that is, what if my football continues to sell for $100 up here, but my variable cost per unit decreases? What would happen? My contribution margin per football would increase, and that would lead to a decrease in the number of footballs I need to sell in order to break even. Okay, let's look at our fixed cost in total. Our fixed cost in total, assuming my selling price per football remains the same and my variable costs per unit related to each football will remain the same. Now I'm going to have a $30 contribution margin. If my fixed cost in total increases, then my break-even point will increase. And that makes sense because I have more fixed costs to cover. But if my fixed cost in total decreases, then it's going to take less football sales to cover those fixed costs. So my break-even point will decrease. So again, changes in estimates. How do these three columns here, these three costs, affect break-even units? When the sales price per unit, we can look at it, sales price per unit will affect break-even point and break-even sales. The variable cost per unit will affect the break-even point, and my fixed costs in total will affect my break-even point. So as any one of these changes, my fixed cost in total, my variable cost per unit or my sales price per unit, this graph is going to change to accommodate that new data, and we're going to see a different type of graph, or same type of graph rather, but our total sales line may change, our total cost line may change, or maybe both, as it would under the pessimistic situation here. My break-even point would be 1,125 units. If under pessimistic circumstances, my selling price per football decreased and I had to increase my variable cost per unit and my total fixed cost increase, then this point would shift upward here. So that's how we can handle changes in estimates. Now, let's look at several applications of the cost volume profit analysis. Now, the first one I'd already mentioned before is the margin of safety. Now, hopefully, all companies want to do better than break even. We want to make a profit. That's what companies are in business to do, is to make a profit and to meet market's demand. Now, company's margin of safety is going to be our expected sales minus our break-even sales, so we'll compute that first. Then take the amount of sales up and above the break-even point and divide that by our expected sales. Now, so we take our expected sales, and let's say we expect to sell, our expected sales are $100,000 of footballs. I have a $20,000 cushion there because my expected sales are higher than my break-even sales. So I'm going to take that cushion there of $20,000 and divide that by $100,000 or my expected sales. And I have a margin of safety in percentage terms of 20%. Now I can express that in units, dollars, or as a percent. So my margin of safety, if I'm expressing that in units, is the number of units sold above the 800 units I need to break even. I can express that in sales. $100,000 minus $80,000 gives me a $20,000 cushion there. Or I can express that in percentage terms, 20%, by taking that cushion and dividing that by my expected sales, and that will give me my margin of safety in percentage. Now, management has to decide whether the margin of safety is adequate given factors such as sales variability, competition, consumer taste, and economic conditions. So we need to determine if this is going to be adequate, or do we need to make some adjustments to that. Now, we can also compute income from expected sales and costs. So we can use the contribution margin income statements to forecast future sales or income. And again, we can do that because we are separating our costs by variable costs and fixed costs. So here we show the key variables in the cost volume profit analysis: sales, variable costs, and fixed costs, and how they relate to income. And this is designed to answer the question, what is the expected income if this level of sales is achieved? So let's illustrate this. Let's assume that Riddell Management expects to sell 1,500 units in January. What is the amount of income if this sales level is achieved using our prior expected cost here? Variable cost per unit of $70 per unit and total fixed cost of $24,000. Well, if I look here, this contribution margin income statement is going to take my sales minus my variable cost to give me my contribution margin. Subtract from the contribution margin my fixed costs, and my income in this situation will be $21,000. So the contribution margin income statement is very, very good at computing income at varying level of sales. And again, that's because we are computing variable costs And fixed costs, we're separating the costs, all of our costs, instead of by product versus period, we're separating by variable versus fixed, or how they behave. So this will give us our income of $21,000. Another computation we can make using the CVP analysis is computing sales for a target income. Let's say we have a specific desire that we want $12,000 in profit at the end of the day. Let's say whatever we sell, we want to have $12,000 of profit at the end. What I'm going to do to incorporate my desire for that target income of $12,000 or that target profit, I'm going to add that to my fixed costs. So my fixed cost plus my desired target income, $24,000 plus a fixed cost plus my desired $12,000 of target income is going to give me $36,000. Now I'm going to take that $36,000 and divide that by my contribution margin ratio, as we determined back here, 30%, and that will give us $120,000. So in other words, I need to sell $120,000 worth of footballs, assuming that they're selling for $100 each, and my contribution margin ratio is 30%. I need to sell $120,000 worth of footballs in order to get my target income. And this is expressed in dollars. Now, what if I want to express the number of footballs I sell? Well, in that case, I'm still going to take my fixed cost plus my target income, $24,000 plus $12,000, $36,000, and divide that by the contribution margin per unit. And that will give me how many units I need to sell in order to make a $12,000 income. Let's take a look at the contribution margin income statement for a moment. Let's say that we only know two things. Let's say that I only know fixed costs, my target income, and my contribution margin ratio. Let's say I only know those three things. I can go back and, with these three numbers here, do a complete contribution margin income statement. How do I do that? Well, if I know that my fixed costs are $24,000 and I want to have $12,000 of income, then my contribution margin by definition has to be $36,000, because my contribution margin is going to cover my fixed costs and my desired operating income. So I have to have $36,000 of contribution margin. Now, if my contribution margin I know is 30%, I'm going to take $36,000, my contribution margin, and divide that by 30% to get the total number of sales. Now, when I have my total sales, I can figure out the difference between my sales numbers, my total sales, and my contribution margin to get my variable costs. So if I know that my contribution margin is 30% of sales, then by definition, my variable costs have to be represented 70% of sales. So I can take that $120,000 now, verify my accuracy by taking $120,000, multiplying that by 70%, and that will also give me my variable cost of $84,000. So I can, just knowing my fixed costs, my target income, and my contribution margin ratio, complete the contribution margin income statement and determine from those three my sales and my variable costs and complete that. Now, I can also undertake some evaluation of business strategies. For example, let's look at three separate independent are two separate independent situations here. Let's say that under the old assumptions, sales price of $100, my variable costs $70 per unit. But let's say now that I want to take into account buying a new machine. And let's assume that new machine increases my fixed cost from $24,000 to $30,000. But now that machine is going to decrease our variable cost by $10 per unit, from $70 per unit to $60 per unit, just because of buying that new machine. Now my revised break-even point in sales is $75,000 instead of $80,000. So sometimes when we change one thing, like buying a piece of new machinery, it may lower my variable costs because now I'm requiring less direct labor. So if I'm affecting two different things here, this formula will tell me now how much I need, what my new break-even point in dollars is going to be. Okay. Let's go back under the old assumption and let's change something. My old assumption was my selling price per unit is $100. My variable cost per unit are $70, so I have a contribution margin ratio of 30%. But let's say I want to undertake a spending or advertising campaign, and the advertising campaign on a per month basis is going to be $3,000. Now, I'm spending $3,000 regardless of how many units I sell or don't sell. I'm just going to undertake that spending of $3,000 in monthly advertising. Okay, so now my fixed costs, instead of $24,000 for whatever my fixed costs were, I'm adding $3,000 to that in my advertising campaign. So now what do? I have fixed costs of $27,000. And this is inclusive of my $3,000 increase in fixed costs. Divide that by my contribution margin ratio of 30%. I now have to have sales of $90,000 in order just to break even in terms of sales dollars. Now, what if that increase in advertising resulted in an increase of sales? Let's say now instead of selling $100,000 worth of footballs, I sell $125,000 of footballs. Okay, so I have my new expected sales because my sales have increased because of my advertising campaign. My sales increased to $125,000. My break-even point is $90,000 in sales. So I'm going to take the difference of that $35,000 difference, divide that by my expected sales, and that gives me a revised margin of safety of 28%. So what happened here? The advertising campaign I had of spending $3,000 increased my sales, and now not only did it increase my sales, my fixed cost went up, but it also increased my sales, but it also affected my margin of safety. My margin of safety now has been revised to 28%. Is that good or bad? Let's compare it to what my former margin of safety was. Previously, our margin of safety was what, 20%. Now my margin of safety is 28%. So the margin of safety, remember, is the cushion that we have above the break-even point at which we can lose sales before we start losing income. So my margin of safety has increased as well, and this is good. That $3,000 spending, while it increased my fixed costs, and then that affected my break-even point in the sales. What happened was my actual sales or my expected sales increased by such a proportion that my margin of safety actually increased. I have a bigger cushion now just by undertaking that additional advertising campaign. Now, we've looked at different situations with a company that has one product to sell. So we looked at it from a one product standpoint. But what if we have multiple products that we sell? Well, we can compute the break even point for a multi product company. Now, the CVP formula can be modified for use when a company sells more than one product. So, what we're going to do is the unit contribution margin is going to be replaced with weighted average contribution margin per unit, and we're going to take into account the sales mix. Now, when we talk about sales mix or bundles or whatever, we're not talking about bundling literally two of one with one product of another and sell those three as one thing. We're just talking about proportionality. And we're talking about the sales mix is going to be the proportionate number of sales volume for each individual product. And then we're going to combine that. For example, if a company normally sells 1,200 footballs and 800 basketballs each month, we're going to have a sales mix of 60% footballs and 40% basketballs. Now, how do we do that? Well, we out of our total sales of 2,000 units, 1,200 are footballs, 800 are basketballs, so we're going to proportion that out. So in this case, the sales mix is going to be 6-4, or 6 footballs to 4 basketballs. So now, whenever we have a mix of products sold, the break-even point can be computed with a weighted average contribution margin per unit. Now, the weighted average contribution margin per unit is going to be calculated as such. We're going to calculate the contribution margin per unit for each item that we sell. Remember, we used footballs before, early in this session, so we're going to use that contribution margin per unit of $30. But now we're going to introduce our basketballs. Our contribution margin per unit for basketballs is $35. Now, based on the breakdown of sales, remember we said sales of footballs represented 60% of total sales, and sales of basketballs are going to represent 40% of total sales. So in order to get the weighted average contribution margin per unit, I'm going to take my contribution margin per unit for each product and multiply it by the percentage of sales. So I'm going to take my $30 contribution margin per unit for footballs and multiply that by the 60% of sales that it represents. And then I'm going to add to that my $35 contribution margin per unit, and then multiply that by what percentage or the proportionate amount of sales that basketballs represent, which is 40%. So we're going to get a weighted average contribution of $32 per unit. So once I have my weighted average contribution margin per unit, I can now divide my fixed costs divided by my weighted average contribution margin per unit and get a total of 1,500 units that need to be sold in order to break even. Now that I know how many units total between both footballs and basketballs need to be sold in order to break even, then I can break out my proportionality here. And if my total break-even units in sales between both product lines, footballs and basketballs, I can now break that out. 60% football means I need to sell 900 footballs and 600 basketballs in order to break even. So I'm just taking my total break-even units I need to sell between both and multiply them by their respective proportionality to get the total number of footballs I need to sell and the total number of basketballs I need to sell in order to break even. And I can also multiply that out in terms of dollars. How much in contribution margin do I have in dollars? $27,000 in footballs, $21,000 in basketballs. And I get that by taking my unit sales, multiplying that by my contribution margin per unit, which we already determined up here. So for break even, I need to sell 1,500 units, and my contribution margin will be $48,000 between both my football and basketball sales. Now, some assumptions that we make in cost, volume, profit analysis, there are going to be four main assumptions. One, cost can be classified as either variable or fixed. And if we have mixed costs, then we need to go through one of the methods we determined in the previous session to actually separate those variable and fixed costs out of the mixed cost scenario. We're making an assumption that costs are linear within a relevant range. So if I graph it out, I'm going to have a straight line. So that's what I mean when I say costs are linear. The costs are a straight line if I were to graph it out. My variable costs per unit are going to remain the same, and my fixed costs in total are going to remain the same. So it's going to be a straight line. We also make the assumption that units produced are also sold, so that our inventory is going to remain constant. We're not having a fluctuation of inventory levels because the units produced are the number of units sold. Now this breaks down a little bit if my units produced are not equal to my units sold. And we'll get that in a little bit here. Sales mix is constant. So if my sales mix is constant, that is one of the assumptions here. Now, if anything changes here, then my assumptions break down in my cost, volume, profit, and any one of my assumptions that break down in my cost, volume, profit analysis, then we need to make some adjustments here because our cost, volume, profit analysis is going to be less useful. Now, managers understand that cost, volume, profit analysis. It gives approximate answers to questions and enables them to make rough estimates about the future. So now let's take a look at analyzing changes in sales using the degree of operating leverage. And this is an important measurement here because it's going to help us to understand how do changes in sales affect income. So let's look at how we measure degree of operating leverage. Again, the degree of operating leverage is a measure of the effects of change in level of sales on income. So how do we compute that? We simply divide contribution margin by income. Let's take a look at this as far as Riddell. Now, Riddell sells 1,200 footballs at this sales level. And at this sales level, his contribution margin will be $36,000. So the degree of operating leverage is going to be 3.0, taking my contribution margin and dividing it by my incomes, taking this line right here on my contribution margin income statement and dividing it by this line right here. And when I do that, I get an operating leverage of 3.0. Now, what does that 3.0 represent? That for every percent change in sales, I will have a 3% change in operating income. So when I take my change in sales, and let's say that sales either increase or decrease by 10%, I'm going to take that 10% and multiply that by 3.0, and I will get a 30. My change in sales of 30. My change in sales of 10% either way. Multiply that by my degree of operating leverage, and I'll have a change in sales of 30, or change in income, rather, of 30%. So let's take a look at this now. And let's take a look at here at the bottom, our current sales. If sales increase by 10%, then my change in income is going to be what? An increase of 30%. Based on this activity right here, my income will increase. If my sales increase by 10%, 120,000 times 10 times 1.10 will give me $132,000. My income will increase by 30%. If I take that $12,000 and multiply that by 30%, that will give me an increase of sales of 3,600. So my income has increased by 30%. We can also look at that on the flip side. What if sales decrease by 10% in opposition to our current level of sales? Well, if my sales decrease by 10%, instead of making $120,000 in sales, I decrease it by 10% and I only make $108,000 in sales. If that were to happen, then my income would be 30% less than the 12,000. So this is where the degree of operating leverage really helps us out by understanding the impact of the change in sales on our change in operating income or a change in income. So this degree of operating leverage really helps us understand the relationship between sales and income. So that concludes this session. I want to thank you. This is Leroy Meadows. Have a good day.